Over the past year and a half, we've experienced a robust recovery characterized by strong economic growth, historically low unemployment, and high household saving rates. This rapid, broad-based recovery has been buttressed by the congressional response to the challenges of the pandemic, beginning with the CARES Act at the beginning of the pandemic and continuing with the Consolidated Appropriations Act in late 2020 and the American Rescue Plan legislated at the beginning of 2021. As President Biden said last week, we now are entering a period of transition from one of historic recovery to one that can be marked by stable and steady growth. Making this shift is a central piece of the president's plan to get inflation under control without sacrificing the economic gains we've made. We also managed to avert the far worse outcomes that were forecast at the beginning of the pandemic in 2020. After the onset of the pandemic, CBO forecast that unemployment would exceed 9% in 2021. Now we're experiencing historically low unemployment. We're also witnessing sharp reductions in the budget deficit, with CBO recently forecasting the largest nominal reduction to the federal deficit in history. According to their projections, the deficit as a share of the economy this year will be at a lower level than CBO projected before the American Rescue Plan passed. Still, we currently face macroeconomic challenges, including unacceptable levels of inflation, as well as the headwinds associated with the disruptions caused by the pandemic's effect on supply chains and the effects of supply-side disturbances to oil and food markets resulting from Russia's war in Ukraine. To dampen inflationary pressures without undermining the strength of the labor market, an appropriate budgetary stance is needed to complement monetary policy actions by the Federal Reserve.